In this video, I'm going to show you how banks determine your interest rate and how to use this information to ensure you get the lowest rate possible for your home purchase. My name is Brian Diez. I'm with United Mortgage. I was going through my emails the other day and I found this old rate sheet from when I started the business. This is actually back in 2008. You can see the date up here. Okay, I blocked out the name of the lender because I don't know if if I'm not allowed to share this information, even though it's like really old, but still, just to be safe. Back when I started in the mortgage business, I was working for mortgage brokers. And what would happen on a regular basis is banks whom we were on board with would come into our office and they would drop off a sheet like this, which had their interest rates and the programs that they had available, so that when I was working with a customer, I could take their loan information and compare it against all these different rate sheets to see who had the lowest interest rate for this particular loan product. These days, everything is automated. So now I just plug your information into a computer, into a web form on in our system, and it'll automatically check against all the other lenders that we're on board with and spit out the interest rates that are available. Okay, but back then we did this manually. So you can see on this sheet here, first thing you'll notice is that they sectioned off into different types of mortgage programs. So you have a 30-year fixed, a 20-year fixed, a 15-year fixed. These other programs, they're probably not as common anymore, but just you get the idea based on the mortgage program that's going to affect what your interest rate is. So we're going to keep a running tally here of the things that affect your interest rate. So loan program, 30, 20, 15. All right, so those were, you can see how the interest rates get lower. So let's say, for example, 5.25 would cost 1 point. So you'd have to pay 1 point for a 15-day lock to get 5.25 on a 30-year fixed. Whereas if you only wanted a 20-year, it would only cost you 0.875 to get 5.25. Okay, so let me show you how to read this real quick. So this would be the interest rate over here on the left-hand column. Then this is the lock period, whether you want to lock the interest rate for 15 days, 30 days, or 45 days. The thing to understand about a rate lock is when you are applying for a loan, the interest rate is changing every hour until you lock it in. Once you lock in that loan, that interest rate rather, you have to close before the lock expires. If the lock expires, some lenders will allow you to extend up to an additional 30 days for a fee. Others, too bad. So that really just depends. Oh, excuse me, get rid of that. So the longer the lock period, the more expensive it is. Yeah. All right. So on this particular day, 5.5 on a 30-day lock would be it wouldn't cost you anything. If the numbers are in brackets, then the lender is actually getting a rebate. So the bank is actually making half a point by selling 5.625. So they're getting half a point back on a 30-day lock on this particular 30-year loan on this day and time. That's how it worked out. Whereas if they went for a 20-year at 5.5, you can see that they're getting 1/8 of a point in yield spread. So they're actually making 1/8 of a point by selling 5.5 on a 20-year instead of a 30-year. Okay. So the lock period also affects your interest rate, right? Whether it's 45, 30, or 15. Okay. So now these interest rates are affected by what we call adjustments. The adjustments you'll see are down here. So the first adjustment is going to be loan to value. So whether the loan is for 95% of the value of the property, 90%, 85, 80%, 75. So every 5% or so, you can potentially see an adjustment. You can see that you don't always get an adjustment, but the loan to value can be affected by. The rate can be affected by the loan to value. So let's put that on here. Loan to value. So loan to value is basically percentage of value of the property, right? So are you trying to borrow 100% of the value of the property? Are you trying to borrow 80% of the value of the property? That will affect your interest rate, okay? And we have primary two unit. What a primary means is a house that you're going to live in as opposed to an investment property, okay? So primary two unit, so two family. Let's call it type of property. Type of property. Whether it's two family, You can see a 3 or 4 family, so 2 family. There's adjustments. There's a half point adjustment if you're putting down 5% on a 2 family. On a 3 or 4 family, you can see that you can't even get a loan unless you're putting down at least 20% with this particular bank. So you have to put down 20%. At which point you'd be getting on a 3 family, it'd be a 1 point adjustment to the interest rate if it's a 3 or 4 family, right? So that covers the type of property. Now this one, NOO means non-occupier. So if it's an investment property, right, you're not going to live in it, you're going to rent it out, then you can see that there's an adjustment, rather sizable adjustment. The reason why it's such a large adjustment for investment properties is because from a bank's experience, from lending experience, when someone purchases a home that they're going to live in, they're going to try to make all their payments before they're going to try to make payments on a property they own just for investment purposes. Okay, so it's more risk for the bank. So you can see there's a sizable adjustment if it's an investment property. So let's call it occupancy. Are you going to live in it, owner, occupied, or investment? On a refinance, you can see there are adjustments for cash out. So you can refinance and lower your interest rate or the number of years on the loan. That would be considered a rate and term. Or if you refinance and you want to take cash out to, let's say, make home improvements or consolidate debt, there would be an additional bump to the interest rate to take cash out. Obviously, if you're taking cash out, it's a larger loan, it's more risk to the bank, which is why there's a bump to the rate, right? So on refinance, cash out versus rate term. Give my OCD. Okay. You can see that there's another adjustment for interest only. Right, interest only loans, the balance is never going to get paid down, so obviously there's more risk to the bank longer term. So that's where there's an adjustment to the interest rate. So I think interest only would fall under loan program. So let's just say or interest only. Okay, so next adjustments, FICO adjustments. Your credit score will obviously have an impact on your interest rate, right? So the lower the credit score, the larger the adjustment. If you have a 700 score, there is no adjustment with this particular lender. But once you drop to 699, there's a half point adjustment, regardless of the loan to value. If you have a 660 score, there's an adjustment. The loan to value, the greater the loan to value, the greater the adjustment as well. All right. So, for example, if you have a 615 score and you're putting down 5%, there's a 2 3/4 adjustment to the interest rate. But if you're putting down 30%, then there's only 3/4 of a point adjustment, right? So credit scores. One thing to note about the credit scores is you can see they adjust like every 20 points or so, right? So 620 to 640 to 660 to 680. So if you have a 679 score, it makes sense to invest some time and energy getting your credit score to 680 because you're going to be saving money, potentially half point or 3/4 of a point with this particular lender. Okay. Same thing with the loan to value. If you're putting down with this particular lender, let's say you're putting down I don't know, maybe it's a refinance. At 30% down, you're getting one interest rate. At 29% down, you're getting one interest rate. If you put down 30%, it's literally 2 points lower. So why wouldn't you put down the additional 1% to get that interest rate? Right? Now these adjustments are not the same with every lender. Every lender has their own adjustments. You don't know unless you ask how you're if there's anything you can do to get a better interest rate. Will putting down more money get you a better interest rate? Will improving your credit score get you a better interest rate? All right, some other adjustments over here. So New York, if the property is located in New York, is a 1/4 of a point. So location. Escrow waiver. We really don't do escrow waivers anymore, but if you didn't want to escrow your taxes and insurance as part of your mortgage payment, there'd be an adjustment there. Subordinate financing, that's kind of like a less and less type thing, but if you're taking out like a second mortgage with it, then there's an adjustment to the pricing. These are all of these are loan programs that this particular lender offered, so we'll just consider that under loan programs, okay? You can see down here, loan size adjustments as well. If the loan is under 100,000, it's a 1/4 of a point adjustment. If it's under 75,000, if it's 50 to 74,999, it's a half point adjustment. So loan size. Okay, so all these things will affect your interest rate. So when someone calls me and say, "Brian, what's my interest rate?" but they don't even have a house yet, they're not under contract, they're still looking to buy a house. For me to quote an interest rate without all this information, I'm just spitting out some random numbers, and there's nothing to prevent me from saying, "Oh, 2%," knowing that I'm just making numbers up. Honestly, I don't feel good about doing that, which is one of the reasons why I'm making this video, because I hate it when people ask me that without giving me this information. If I give you a number, I'm not educating you. I'm just trying to persuade you, and I'm not about that. I'd rather have an educated client than one that I could just manipulate. I don't want to manipulate anybody. I want you to have a safe and pleasant experience when you buy a home. Let's take a look at Chase. Okay, so this is Chase's mortgage product today. The interest rate on Chase loans. So a 30-year fixed, the rate is 2.875. Right, you can see that 15-year, the rate's 2%. So obviously, you're saving money if you can do a shorter term on the loan, right? Let's scooch down here and read the fine print. Rates displayed in the table include approximately 1 point and are based on the following assumptions. So by prepaying interest, you can lower your interest rate, right? So if you weren't paying 1 point, then these rates would be higher. Maybe it's not 2.875, maybe it's 3 1/8, or 2% might go to 2 1/4. So prepaying interest can affect your interest rate. All right, so the following assumptions are made. Conforming 30-year, 15-year. So this is for 30-year, 15-year. These rates, 30-year, 15-year, right? It's also some adjustable rate mortgages, whatever, they're listed there. We don't need to go over that. And these are based on a loan amount of $349,999. So you're telling me that if my loan size is $350,000, I could potentially have a higher interest rate or even a lower interest rate. I don't know. I would have to ask. But without knowing this information beforehand, what if paying $1 more, putting $1 more down on my purchase? I'm buying a house for $400,000 and I'm putting down $50,000. What if putting down $50,001 gets me an eighth of a point lower on my loan, and now I'm saving $10,000 in interest over the life of my mortgage? Isn't that good information to have? So, like I said before, we all banks use the same types of filters of adjustments when they're pricing up loans, but they don't always have the same breakpoints. Like that other lender, and you have to have less than $100,000, a loan size of less than $100,000 for them to adjust your interest rate. With Chase, apparently anything under $300,000 or over $350,000 is going to adjust your interest rate. All right, so you have to ask. Also, FHA versus conventional loans. That's also you can see FHA rate down here on a 30-year is 2.5, as opposed to a conventional is 2.875. All right, so the type of loan that would fall under type of loan, but we should have probably add that as well. So loan program, loan type, FHA versus VA versus conventional. This is US. These are like the most common ones, okay? Okay, so now you have an idea of how lenders determine your interest rate. They look at all these criteria, they make the adjustments, and that's how they come up with your interest rate. So these are the things that you can potentially have within your control to manipulate in order to reduce your interest rate as much as possible. If you want to see if you're getting the best interest rate, or you want to see what kind of mortgage, the loan amount that you might qualify for, please reach out to me at briandiez.com. And there's no cost, there's no obligation, but let's see what you can qualify for and see if we can't save you money. At the very least, by the time you're done with me, you'll know that if you decide to go with another offer, that you know you're getting the best terms available to you. Thanks for watching.